This year we've seen interest rates move up in response to high inflation, and with those increases, mortgage rates have started to move up as well, with the average 2-year fixed rate mortgage more than doubling since the start of 2022. For many people who are fortunate enough to have spare capital left at the end of every month, the choice of whether to pay down debt or invest has been relatively straightforward over the past decade, because debt has been cheap and investment markets have done well, meaning the balance has been in favour of investing. Rising interest rates and falling investment values this year, though, have made that somewhat cloudier, and many of you may now be asking yourselves the question, is it finally time to focus more on paying off debt? There are a number of factors to consider, of course, in addition to just where interest rates might be going. And throughout this video, I'm going to highlight and explain these factors so you can make the best decision for your own unique circumstances. If we haven't met before, I'm Chris Bourne, and as a financial planner, I've been helping people achieve tax-efficient financial independence for the last 17 years. I make videos to simplify financial planning and help you make better financial decisions. Subscribe and turn on those notifications if that's the type of content you're looking for. And without further ado, let's get into it. Since December of last year, our base rate in the UK, which is set by the Bank of England and used to determine our borrowing and savings interest rates, has moved up from 0.1% to 1.75%. as at the 4th of August. What's more, it's almost certain that we're going to see further rate hikes, and it's thought that they could be at 3% by February next year. People who aren't on fixed rate mortgage deals already will have seen their payments increase, and that will continue to happen. People who are on fixed rates will find that their payments are much higher when their current products expire, because replacement rates could be at least double what they were previously. This is one area, though, that isn't always fully understood by people. Many will remember that before the global financial crisis that started to take hold in late 2007, our base rate had hovered around the 5% mark for quite some time. Naturally, if you've been enjoying a fixed rate of 1% on your mortgage, you'll be worried about rates reaching those same levels again, because that would represent a 5-fold increase in mortgage payments. But it doesn't actually work out like that. If we look at this example of someone who's borrowed £200,000 over 20 years at a 1% interest rate, their repayments would be £919.79 per month. However, if that rate doubled to 2%, the repayment over the same period would only increase to £1,011.77. So even though the rate has doubled, the payment hasn't. In fact, the difference is only 10%. Similarly, if the rate was 3%, the monthly payment would be £1,109.20. At 4%, it would be £1,211.96. And even at 5%, it would be £1,319.91, which represents a 43% increase, not the 500% increase people may fear. Now, of course, a 43% increase would still be uncomfortable for many people, but not as bad as you may have originally thought. And that then leads on to another common misconception, which is that people think the cost of borrowing is the interest rate they pay. But it's not. It's actually the difference between the borrowing rate and the current rate of inflation, which, as we know, is quite high at the moment. It's sometimes forgotten that one of the positive effects of inflation is that it reduces the real value of fixed debt, just as it reduces the value of capital sitting in your bank account. Let me give you an example. If you'd borrowed £10,000 at the beginning of this year at a rate of 3%, that would mean that in a year's time, you'd owe £10,300. If the rate of inflation we see over the course of this year is 8%, though, the true value of that £10,300 has reduced to just £9,476, meaning that you've actually made a profit of £524, or just over 5%. So even if interest rates do increase and you're paying a higher rate on your mortgage, you have to deduct the rate of inflation to arrive at the true cost of borrowing. If your next fixed mortgage rate is 4%, let's say, and some inflation persists into next year at around the 5% level, the cost of borrowing is actually negative, meaning you're benefiting from that borrowing in real terms. If inflation does return to the Bank of England's long-term target of 2% in 2024, your cost of borrowing would still only be 2%. So even though there is concern about rising borrowing costs, when you put it into the context of your long-term wealth, there may not be as much cause for alarm as you initially think. And if you are in the fortunate position of being able to choose whether to make overpayments or invest, you need to bear that in mind. So the next factor to consider is, what return am I likely to get on my regular investments in this current climate? Well, we've all seen falls in our investment values this year, and even though we've seen much more positive returns in recent weeks, there's no sign of the volatility and uncertainty abating just yet. The upside to falling markets, though, is that from the middle of this year, growth forecasts were actually higher than they were a year previous, because they were starting from a lower valuation. We can see here that the expected growth ranges from mid-year 2022, shown in green, are now higher than what they were at the end of 2021 for global equities, UK bonds and global bonds. The UK equities growth forecast has fallen back a bit because it actually performed better than the rest of the world in the early part of this year. But the UK is still expected to slightly outperform the rest of the developed world over the next decade. So this is quite positive news if you're trying to decide whether to invest or whether to pay down debt. However, just as we have to take inflation into account when determining the true cost of debt, we equally have to take it into account when determining the real return on investment. If we used the previous example and said that we expect inflation to be 5% next year, and we assumed that you received the median return for global equities, which is around 4.6%, you've actually made a loss in real terms of about 0.4%. However, if inflation did then return to the Bank of England's long-term target of 2% and you continued to receive the same average return, your money would be growing in real terms by 2.6% a year. As long as your money is growing by more than the cost of living is going up, that's all you really need. So it would seem that in the short term, with inflation high, you may be better off paying down debt. But of course, we're planning for our long-term future. And based on projections at least, you're still likely to gain more by investing regularly, even though the marginal difference between the two options is much tighter than it has been for some time. Now, up until this point, of course, we've just focused on the mathematics of the comparison. But there is another very important factor we need to consider when making our decision, and that's the emotional factor. Now, before you poo-poo it, we have to remind ourselves that we are, at the end of the day, human beings and we are emotional creatures. Not everything can be a cold mathematical decision because we're not wired that way. If we allow ourselves to be completely logical, studying all of the data on historic returns, we can work out that when investing money, there's a strong possibility over a long enough period that we'll end up with more money than if we decided to make overpayments on our mortgage. If we assume you're fortunate enough to have an extra £300 a month to allocate somewhere, using the same examples from earlier on, we can see that over a 10-year period, the 2% real return you'd save by overpaying the debt would amount to £3,815.90, whereas the 2.6% real return you'd gain by investing would add up to £5,062.90, a £1,247 improvement, or a 33% improvement in percentage terms. But there is a lot to be said for the feeling of being debt-free sooner, the comfort and financial security that provides, particularly if you're a couple and one of you is a risk taker and the other one isn't. I see that a lot. Because here's the real kicker. Growth on your investments is a probability that increases with time. But the saving brought about by overpaying your mortgage is a certainty. And in a world where there are very few certainties, some people like that, and they're not wrong to do so. So what should you do? Well, there really is no should, because that implies there's a right or a wrong answer, when really there are just a number of different paths that all lead to the same destination of your financial independence. Some of the paths are shorter, but they might be slightly less comfortable to walk. Other paths are longer, but the journey might be a little more smooth. When it comes to overpaying on debt or investing, we can always do a bit of both. You don't have to just choose one option. It all boils down to our personal preferences on risk, our capacity to take risk, and the time period we're planning over. Speaking of risk, if you want to know the biggest mistakes I've commonly seen people make as a financial planner, watch this video next, so you can be sure to avoid the same mistakes yourself. I hope that's been helpful, guys, and I'll see you soon.